A severe depression has started. I'm your host, Steve Van Metre, and thanks for joining me today. And China's property market is far worse than we thought. With prices crashing, it's headed into a severe depression. Let's over to Wall Street Journal, who headlines the story with China's property market has slid into severe depression, according to real estate giant Country Garden, which for years has ranked as China's top real estate developer, now reports a 96% drop in first half profits. All these exert mounting pressure on participants in the property market, which has slid rapidly into severe depression, the company said. It added that a resurgence of COVID-19 in cities across China has also slowed construction activity and weighed on its performance. The company has long been regarded as one of China's financially strongest developers, but like many of its peers, has struggled to overcome a crisis of confidence that has caused homebuyers and investors to back away from the Chinese property market. Now, I want you to think back to the great financial crisis. Where did these real estate crises start? Is it in the bundling of the loans and all that? No, all that stuff can keep going on. Where it starts is when demand goes away, and what you're seeing here is people stop buying. As long as people continue to buy, the Ponzi scheme can continue to go. But the moment people give up, as you're seeing right now, it's over, and that's what we're hearing coming out of China's property market, that it's in a depression. And the shares and dollar bond prices have plunged this year despite Country Garden's repeated attempts to convince the market that it can withstand the crisis. The company was recently among a handful of developers that were picked to sell government-insured domestic bonds. And nothing says that you're financially strong than having the ability to sell government-insured bonds. I mean, what a way to give people some confidence that you are in a financially strong situation. Hey, don't worry about us. You can just buy some of our bonds that the government is backstopping. Tells you the things there are far worse than we thought. As more than 30 Chinese real estate companies, including China Evergrande Group and Sunac China Holdings, have already defaulted on their international debt, as we've covered on this show. Many privately run developers this month issued profit warnings. Some said they're expecting more than a 90% decrease in net profit, and few are expecting to post losses. And China's deflating property bubble also spilled over into other sectors, no surprise, including the country's privately run banks and its largest state-owned asset managers that specialize in managing portfolios of troubled loans and distressed debt. And sure enough, when you have more troubled loans and more distressed debt, what's going to happen is the whole thing comes spiraling down. But there's one thing that shouldn't come spiraling down with China. That's your portfolio. I'll put a link up here to Portfolio Shield and description below. Let's continue on, because China says that, hey, maybe things aren't that bad. As Premier Li says, stimulus now more forceful than in 2020. And Li was speaking during a Monday meeting at the State Council Cabinet, where he added that the size of stimulus in 2022 has been reasonable and appropriate according to news reports. And the economy was affected by unexpected factors. Well, shutting down your economy is not really an unexpected factor. In the second quarter, reiterating a pledge to stabilize employment and prices. He said the policies have been announced so far need to be implemented so as to keep the economy running within a reasonable range. And so what you're seeing here is massive stimulus isn't working. And what we talked about on a previous show is, will China devalue the yuan? And you're seeing it. This is the last stand. If stimulus doesn't work, and it doesn't appear to be working because the global economy is slowing and the property market is crashing, well, it means that a deval is not too far away. But let's continue on, because Beijing last week announced a 19-point stimulus plan, which included more than 1 trillion yuan, or 145 billion worth of funding, largely intended for infrastructure spending, in its latest bid to bolster growth and employment. But what is the real story here? It's all about the dollar. As the dollar edges higher, as oversized Fed rate hike bets are on the rise. And so what we're seeing in China is the yuan is falling in value relative to the dollar. That's causing major problems. It leads to a lot of inflation in China, more than they normally would want. And they're designed to deal with inflation, but not the rate of inflation they're seeing now. And so now we're starting to see that perhaps the property market issue is coming back to the dollar. Not just the strength of the dollar, but what is causing the dollar to get stronger? And that's a dollar shortage. But the news, they don't see it that way at all. The dollar edged higher on Tuesday, but was below the 20-year high it hit a day earlier, while the euro broke back above parity as markets priced in supersized interest rate hikes by the U.S. Federal Reserve and the European Central Bank. And we'll just see how long those will last. The greenback has been supported by aggressive rate hikes by the Fed in an effort to reel in decades-high inflation, and economic data released on Tuesday gave the central bank no reason to hold back. And so there you see it, is a story about the dollar is all about the Fed when it really is all about the dollar shortage. Now, what does this mean for, of course, the U.S. bond market? Is we're going to see the front end of the curve push a bit higher. Now, why does that actually matter? Because when you think about where new money is created, it's created when people borrow. So if rates go higher and people stop borrowing, well, what does that mean? The dollar shortage gets worse. Here we see the U.S. 2-year yields back away from the highest since 2007. As bonds pair the sell-off driven by Powell's Jackson Hole speech. We retain our view for a flatter curve, according to Nomura. Of course, the curve is going to go screaming higher in reference to the yield curve. The U.S. 2-year rate paired a surge ascended to the highest level since November 2007, following Federal Reserve Chair Jerome Powell's Jackson Hole speech that a restrictive stance was likely to remain in place for some time. European bonds led losses after a top central bank official said more tightening is needed, even if the economy tips into recession. But don't worry, the ECB is not likely to keep doing that. But what we want you to see here, why these 2-year yields matter, is because when 2-year yields snap and break, when they start coming down, they're telling you that the Fed's hiking cycle is over. So here we see in red the 2-year constant maturity yield and against the federal funds rate in blue. And so you can note that every time, even if the Fed is continuing to hike, but 2-year yields start coming down, what it's telling us is the cycle is over. And are we there yet? Well, maybe not quite. I think the September is the last hike we'll see from the Fed. We'll see it between now and then if 2-year yields start coming down. But the reason the market's so convinced that rates are going to head higher is because some reason they believe in the Fed. With this headline, the Fed's John Williams says rates will stay high for a while. As the Federal Reserve Bank New York President John Williams said Tuesday that they want to keep short-term interest rates above 3.5% or push them above 3.5% and hold at that level through next year. Our focus is on getting inflation back down to 2%, and the current level of price pressures are far too high. To reduce inflation amid a strong labor market, Mr. Williams said the Fed will very likely need to raise rates high enough to slow economic activity. Translation, we are going to send the economy into recession, and to do that, interest rates will need to rise above the inflation rate, which he said expects to fall between 2.5% to 3% next year. Well, reality is it's probably going to fall more than that, potentially even go negative and put it into these Fed rate hikes. But we're going to need to have restrictive policy for some time. This is not something that we're going to do in a very short period of time and then change course. Well, I'll take the bet on that. We'll continue through next year with a restrictive policy stance. It's going to take some time before I would expect to see adjustments of rates downward. Well, that's not what the yield curve is suggesting. It's not what the Eurodollar's futures curve is suggesting. It's not what China's properties market is suggesting. It's not, of course, what's going on in Europe, another factor that could be headed to also their own severe recession. Europe braces for rationing risk and Russian gas slowdown, as the worst case scenario would entail a complete cutoff in Russian gas to the region and an early cold snap. With fuel alternative supplies available, a surge in heating demand would propel prices to new heights, which could foment social unrest and test Europe's resolve to support Ukraine. And the reason that is a problem there is because they're being warned of a severe recession in Germany if Russia were to completely halt gas supplies. While the country is among the most vulnerable, the risk extends to Austria, India, and some countries also receive Russian gas through their neighbor, and cuts may disrupt that trade. So what you see is China's headed into a severe depression. Europe is probably headed there as well, and that means U.S. is the last island to go. And of course, many people say that that can't happen, but what we need to do is get the pulse of what our chief strategist Jeff Snyder says and see what his latest prediction for the global economy in Europe might be. He talked about in his daily, according to the European Commission, overall sentiment for the euro area declined in August of 2022. And having remained relatively firm, both industrial sentiment and that for services in Europe may have begun to buckle under the recessionary weight of price increases, along with questionable, to put it mildly, demand. Even with the relatively high marks in those two ESI categories, the overall index has reached well inside recession levels. The rate of deterioration is a factor here too, as it is how widespread, and what a bold prediction from our chief strategist that, of course, Europe is also headed into a recession. And with that, now you can see that all these things combined say that China is just leading where the rest of the world is headed. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.